Good afternoon, everyone. Today we will talk about forecasting techniques. As we all know, during the pandemic, the exchange rate fluctuates greatly, so the exchange rate forecast is even more important. And exchange rate forecasts are divided by the computation of value relative to other foreign currencies for a definite time period. Using a currency exchange rate forecast, techniques can help brokers and the business make informed decisions to help minimize risks and maximize returns. For the multinational business firms, it can help hedging decisions. It's like managing foreign exchange exposures, and financing decisions is about where to raise long-term capital. And the third one is capital budgeting decisions. It's about FDI locations. And the next one is profit remittance decisions. It's about where and when to move profits. And the last one is short-term financing decisions. It's like to managing idle cash. And for global investors, it can constructing appropriate portfolios. And my teammates will introduce the two methods to you.
Now, I'm going to talk about the fundamental approach. The fundamental approach studies a wide range of data according to the fundamental economic variables, such as inflation rates, trade balance, consumption, interest rates, national income growth, and so on. The fundamental approach begins with a model that produces a forecasting equation. The model is based on a purchasing power parity theory, a combination of theories or on the ad hoc experience of a practitioner. There are 5 steps in the fundamental forecasting. According to the first 2 steps, the forecaster compiles data to estimate the forecasting equation. Then the estimated forecasting equation will be evaluated using different statistics or measures. And if the forecaster is happy with the model, she will move to the next step, the generation of forecasts. The final step is the evaluation of the forecast. In this presentation, we will forecast the future value of the exchange rate. The expectation is constructed using an information set selected by the forecaster. The information set should be available at the time t. Below is the notation used for forecasts, where ET represents an expectation taken at the time t, and each forecast has an associated forecasting error t plus 1. And next slide, I'll present you the example of the forecast. Suppose you work for the United States firm. You are given the following quarterly CPI series in the United States and in the United Kingdom from 2008 quarter 1 to 2009 quarter 3. The exchange rate in 2008 quarter 1 is equal to 1.9754 US dollar per British pound sterling. You believe that this exchange rate, 1.5262 US dollar per British pound sterling, is an equilibrium rate, and your job is to generate equilibrium exchange rates using PPP. And in order to do this, you do quarterly example forecast of the US dollar per British pound sterling exchange rate using relative PPP that is shown here. and this is the forecasted level of the exchange rate US dollar per British pound sterling for the next period. Next, I'm going to show you how the future value of the exchange rate and the forecast error are calculated by the CPIs and inflations of both countries. In the first column, there is a period of time between the first quarter of 2008 until the third quarter of 2009. The second and third column are CPIs of both countries, followed by inflation, and the sixth column is the forecast exchange rate forecasted by the forecaster, followed by the actual rate and forecast error. From the table, we can generate trading signals. According to this PPP model, the equilibrium exchange rate in 2008 quarter 2 should be 1.9813 US dollar per British pound sterling, and the market price, however, is 1.9914 US dollar per British pound sterling. That is, the market is valuing the British pound sterling higher than your fundamental model. Suppose you believe that the difference 1.9813 minus 1.9914 is due to mispricing factors. Then you will generate a sell GBP signal. So that's all for the fundamental forecasting.
Well, we have looked at the fundamental approach. Now I would like to continue with the second approach of forecasting foreign exchange rate. It's called a technical approach or technical analysis in other words. Technical analysis is a currency forecasting technique that uses historical prices or trends. Technical approach focuses on a smaller subset of the available data. In general, it's based on price information. This focuses solely on past prices and volume movements, not on economic and political factors. The approach is to sell or buy certain currencies if their prices deviate from past patterns. Technical analysis looks for the repetition of specific price patterns. Computer models attempt to detect both major trends and critical or turning points. These turning points are used to generate trading signals, buy or sell signals. If we describe it in simple words, technical analysis is an art, not a science. As you can see, this figure outlines that technical approach relies on charts, moving averages, filters, and momentum indicators of past prices to predict future exchange rates by generating buy and sell signals. Technical analysis consists of 4 models: moving average models, filter models, momentum models, and newer models. Each model uses its own elements, calculations to create buy and sell signals. In this video, I will focus on the first 2 models and I will talk about them in more detail. Now let's move on with the first model. Moving average is a simple technical analysis tool. The goal of a moving average model is to smooth erratic daily swings of an asset prices in order to signal major trends. It's simply an average of past prices. There are 2 types of moving average models used in technical analysis: exponential and simple moving average models. Exponential moving averages is a weighted average that gives greater importance to the price of an asset on more recent days, making it an indicator that's more responsive to new information. A simple moving average is a calculation that takes the arithmetic mean of a given set of prices over the specific number of days in the past, for example, over the previous 15, 30, 100 or 200 days. I will use the simple moving average to explain the graph. The simple moving average is calculated by adding the price of an instrument over a number of time periods. then dividing the sum by the number of time periods. If we include the most recent past prices, then we calculate a short-run moving average. If we include a longer series of past prices, then we calculate a long-term moving average. The double moving average system uses two moving averages, a long-run and a short-run moving average. A long-run moving average will always lag a short-run moving average because it gives a smaller weight to recent movements of exchange rates. In moving average models, buy and sell signals are usually triggered when a short-run moving average of past rates crosses a long-run moving average. For example, if a currency is moving downward, its short-run moving average will be below its long-run moving average. When it starts rising again, it soon crosses its long-run moving average, generating a buy foreign currency signal. This example illustrates how to generate trading signals for the USD per GBP using the double moving average model. At first, we generate a short-run moving average using 30 days of information. It is showed with the red line in the graph. Then we generate long-run moving average using 150 days of information, which is showed with green line. Every time there is a crossing between the red line and the green line, the double moving average model generates a trading signal. For example, there is a sell GBP signal in late 2007. By April 2009, the model generates a buy GBP signal. Let's continue with filter models. This is probably the most popular technical analysis model. The key of the system relies on determining when exchange rates start to show significant changes as opposed to irrelevant noisy changes. Local peaks are called resistance levels, and local troughs are called support levels. A filter rule suggests that if investors buy a currency when it rises more than a given percentage above its support level, and then sell a currency when it falls more than a given percentage below its resistance level. The idea is to smooth daily fluctuations in order to detect lasting trends. The filter size is typically between 0.5 and 2%. This example shows the determination of trading signals with a filter model. The graph illustrates our example. Let the filter be 1%. First, we need to determine peak or trough. Then we generate trading signals. Sell signal is generated when an exchange rate falls 1% below the previous peak, and buy signal is generated when exchange rate rises 1% above its most recent trough.
This brings us to the end of our video. In summary, I can say that forecasting exchange rates is a very difficult task, but not impossible. As mentioned previously, forward rates are poor predictors of future spot rates. And because of this, many companies and investors simply hedge their currency risk. However, those who see value in forecasting exchange rates and want to understand the factors that affect their movements can use approaches which was mentioned in the video as a good place to begin their research. Thanks for watching.